So you're good at reminding us of the effect of month-end moves. Timing obviously matters.
Yep.
Do you think the Santa Claus year-end rally effect is just as real?
Well, Santa Claus isn't real.
No, he isn't actually.
So is the Santa Claus just as real? The Santa Claus rally just as real? I mean, I recall that when I started this firm, it was coming out of the 2007 top. Unfortunately, for a lot of people, they can't say it. For us, we're quite fortunate. I've never missed calling a topping process, okay? Started out bearish on markets and stocks as a professional short seller in 2000, 2001, went bullish coming out of 2002. Then made the call on the top in 2007, which again, the top was in October of 07. Santa was still fake in October, November, December. As you got throughout the period of 07 and into 08, Santa was still fake news, okay? It was a hope. Everybody wants St. Nick, but it was a very bad time to be betting on the holy moly Mike Santoli, baseball stats. 18 times in the last midterm elections, I can tell you that the stock market's been up this percentage of the time, and there you go. And if you do that and listen to me tomorrow, I will be not accountable to it, but I can tell you some more useless data points if you'd like. I mean, it's just, this is what people look for. They look for safety blankets. They look for shortcuts.
Yeah, totally.
And that's what they really want. They want somebody to make them feel better. But it shouldn't make you feel better, people just rattling off data points. You got to find the sine curve.
Well, investors are always searching for some illusion of certainty, whether it be, these sort of types of empirical, sort of frequentist studies like we've seen with midterm elections, which, by the way, are terrible statistics. I mean, you want to talk about bad statistics? Just saying something is up an average over some random, predetermined, predisposed.
You mean
time?
when after a president is elected that the stock market always goes down, or it goes down a lot of the time by this amount?
Yeah.
Like if you did that,
a lot of the time would be even better statistics than what we're currently seeing. What we're currently seeing is just it's up this average. This is the average return. Mm-hmm. The average return doesn't tell you anything about the descriptive statistics about any sort of different type of scenarios. Clearly, these are not all different scenarios because we're talking about 50 years of data. I digress.
But what holy moly Mike Santoli should say is, what does the stock market do when you're coming out of an election, a blizzard, I don't know, a New England Patriots football win, when you're in quad 4?
Yeah.
Quad 4 is the #1 thing that matters right now, above and beyond anything you can think of, okay? So unless you're starting with the #1 thing, you really don't know what you're talking about, Mike.
Yeah, well, I mean, look, some people's models hinge on things like elections and other sort of what you would call macro tourist fodder, what we would all call macro tourist fodder. Unfortunately, people who've built the biggest, largest, most successful asset management firms could continuously come back to the view that these things called growth and inflation actually matter more to getting returns right than these sort of ancillary topics and things that come along. So clearly, we're going to stick to the process here.